I'm Taylor Riggs in San Francisco in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, clicks before queues. Online sales breaking a Black Friday record with shoppers spending the day online rather than in stores. How holiday weekend spending will turn out following Cyber Monday. Plus, crypto crackdown. China continues its assault on crypto exchanges, and the currencies are feeling the pressure. We'll have the numbers. And our extended conversation with the CEO of Qualcomm, why he thinks 5G will change the way we do business forever. But first, to our top story. It is certainly starting to feel like the holiday season. Americans got out their wallets over the holiday weekend, spending nearly $70 billion on shopping over that 4-day period. And Amazon is gearing up for that heavy spending month by heading back to basics. Testing cheap warehouses that will let merchants store inventory close to Amazon's delivery operation. The goal is to keep from running out of popular products. It will also let merchants avoid storing their goods in Amazon's warehouse space where they pay premium prices. To discuss, we are joined now by Bloomberg Technology's Spencer Soper. Spencer, what do we know about the new service called Storage and Replenish?
Yeah, so we just know that they're giving this a try in Southern California, in Ontario, California. It's about 20 miles from their closest delivery hubs. And you just kind of highlighted it nicely. The problem with Amazon this time of year is always this race to create capacity, and it has these very expensive, highly automated facilities with conveyor belts and robots shuffling things around. Those facilities are so expensive, they're not used, it's not smart to use them for storage. So Amazon needs to supplement the storage capacity of those facilities with just some cheap, plain old warehouses nearby. So that's what they're trying this year in Southern California, and they're kind of scouring the country for cheap warehouse space near their other facilities around the country. So it looks like this thing could ramp up if it goes well this year.
Spencer, talk to me more about that. You said that they had that one warehouse in Ontario, California, about 20 miles away, but notably that's only one, which means it isn't ready for Cyber Monday, for example. Are there concerns that there wasn't, more of these locations heading into this holiday season?
Well, the tension has been that during the holidays, Amazon hits capacity. Its facilities hit capacity, and it only wants the fast-moving inventory in there. It doesn't want to clutter up the space storing goods that aren't selling. And so what Amazon historically has done is it simply raised its storage fees in November and December to try to discourage its merchant partners, these independent merchants that sell things on Amazon, to discourage them from putting stuff in their warehouses. And so the risk of that is, well, maybe they can run out. And so this is kind of like the happy medium. We don't want your stuff cluttering our warehouses during peak season, but we're going to provide a storage space nearby that's cheap so you can have the stuff nearby in case we do need to replenishment. So it's kind of like the next phase of them trying to declutter their warehouses without running out of inventory.
What's been the merchant reaction to this?
Well, if this goes well, it could be favorable, because that's been the concern of the merchants. Is when Amazon did jack up its storage fees in November and December, they had to make this critical guessing game. I want to send them just enough to get through the holiday season. If I don't send them enough, I'm losing sales. If I send them too much, I'm getting hit with these very high storage fees. So this is a way to create a little bit of a buffer, so you can send more than you think you're going to sell without getting penalized so heavily on the storage fees, because there will be a cheaper storage solution nearby.
Spencer, we often hear that in the shipping business, it is that last mile that is the hardest. How does this help Amazon both in the middle of the supply chain and that final mile to get the product to the actual front door?
Well, especially as Amazon goes for this next day delivery pledge. They're trying to shift more and more of their inventory to next day as opposed to 2-day. And if they're going to accomplish that, they need to have inventory close to shoppers. They have less and less time to react from the moment someone clicks buy on their website, or on their computer or on their smartphone, to the time they can get that order out the door. So it's critical that they narrow these gaps of where the inventory is. And so when you used to maybe have a handful of facilities that could adequately serve the entire country, now you need at least 16 stations to reach all customer, the majority of the U.S. population next day, and so that means you're going to need these ancillary facilities around it to store inventory to feed into those systems.
Bloomberg Technology's Spencer Soper, thank you for joining us. Now, to continue our discussion about Cyber Monday, let's bring in Dan Ives of Wedbush, and also with us, Stephen Krause. He's head of digital insights at JumpShot. Stephen, we've just talked a whole lot about Amazon. How has this Cyber Monday compared to previous years?
The holiday season is off to a really strong start. If we look for Black Friday, for example, we see that on the digital transactions that we track at JumpShot, this Black Friday was up 19% versus Black Friday a year ago. Going back a year, that Black Friday was up about 20% over the year before that. So that all adds up to very consistent growth, and we think that's going to add up to today being the biggest Cyber Monday ever.
Dan, in your opinion here, is Amazon the key player who's a clear winner from all of this?
Yeah, look, it continues to be their world. Everyone else is paying rent from an e-commerce perspective. But look at Walmart and Target in terms of some of those year-over-year numbers. So I think you are starting to see the traditional retailers catch up. But this continues from an investor perspective to really be Amazon, as well as even when you think about some of the products, I think Apple and AirPods and some others that are really what I would call the winners so far from what we've seen.
And Dan, we just came off of a conversation about Amazon and the investments they're making in one-day shipping. Is that cost paying off yet?
Well, I think that's, from an investor perspective, that's really the focus here. I think it's starting to pay off, but that's really going to play out in the next 6-12 months in terms of next day shipping. That continues to be a core advantage for Bezos and the Amazon machine. But you see e-commerce right now, you're starting to see a narrowing in terms of some of the competitors right now. So that last mile, that white glove service continues to be the focus of investors to really close the gap.
Stephen, you've been nodding here. How much has the pressure increased to get the shipping time faster?
Yeah, certainly Amazon has upped the game with the announcement of one-day shipping. And earlier in the year, there was a lot of talk about Amazon didn't want to sell what they were calling the crap products, can't return a profit, those low-price products. And then within a couple of months, they very quickly pivoted and said, you know what, we are going to sell those, and we're going to do those one-day shipping as well. And a lot of it's coming from the competitive pressure that Dan mentioned, that the traditional retailers like Walmart and Target, with services like click and collect or buy online, pick up in store, they've had pretty good years as well.
Both of you have mentioned Walmart and Target, so I want to come and show a chart that I'm showing here inside my terminal, which has been department stores kind of hitting a rough patch. Same-store sales on aggregate falling 1.6%. This is hardly a new trend. Clearly, as people aren't going to the brick-and-mortar stores, it has become an online business. But Dan, as you've mentioned Walmart and Target, what are they doing at the brick-and-mortar that helps them, frankly, to be able to take on the companies like Amazon?
Look, it's really about inventory and around that e-commerce sort of machine. You've seen it come out of Bentonville. And I also think it's some of the talent. I mean, I know many e-commerce players that Dave hired at Walmart. So they've stepped up their game. It's about inventory. And as Stephen hit on right now, it's no longer asleep at the wheel. It's a narrowing of the gap. Consumers are smart. It's not just Amazon, but that continues to be in the eyes of the street right now. Who are the winners? And you really got to put a feather in the cap right now for Walmart.
And are Walmart and Target, Stephen, in your opinions, also the clear beneficiaries along with Amazon in this environment?
They are. They're clearly pulling away from the competition. I mean, just as you see in so much of the digital world where you see it's a winner-take-all market, just as you've seen Google and Amazon and Facebook pull away from their relative competition, as we look within specific categories within e-commerce, we see the same things, that the dominant players pulling away, finding niches where they don't really have to compete with each other.
Who, Stephen, in your opinion, have been struggling? Who are some of the losers that are coming from this that haven't been able to keep up.
It's interesting. When we look at companies that have had a big boost from Black Friday, it's not always a positive story. So we've seen big boosts on Black Friday from retailers like Victoria's Secret, Forever 21, GameStop, ones that have struggled in some ways. When we look at our data, we sometimes call it the trifecta, that if they had a big boost around Black Friday, but they also had a big boost in paid search, meaning they had to pay a lot to get that traffic, and they have falling prices, that's a trifecta that's tough to rebound from, and that's what we see with a lot of those struggling retailers.
Dan, how do you incorporate the sense of the omni-channel, where whether it be curbside pickup or a great delivery service, how do you incorporate that into your analysis and creating that full omni-channel experience?
Look, it's all about the cost of getting an incremental customer. And I think if you look at Amazon right now, it's all about Prime, right? I mean, once you're in that sort of ecosystem, as Stephen knows well, you're going to spend incrementally more. But it's around the omni-channel. That's not just what Amazon's focused on, what everyone that's chasing them is focused on. That's why when you look at these early Cyber Monday numbers, they're robust, but it's not just one player that's going to benefit. And I think you're seeing across the landscape here.
Dan, you cover Apple, so I would be remiss if I let you go without asking a quick question here. Forecast for the holiday season when it comes to Apple.
Look, I mean, right now, in terms of AirPods, that continues to be tracked, and I think about 65 million in terms of units for 19. But the big thing here is iPhone 11. I think tracking 10 to 15% above expectations. And if that continues, this is a stock that's going to have a 3 in front of it going into early next year.
Stephen Krause, head of digital insights at JumpShot, and Dan Ives of Wedbush. Thank you both for joining us.
Thank you.
And shares of Roku plunged on Monday. This is after Morgan Stanley downgraded the streaming video platform from equal weight to underweight. The bank says Roku could see revenue and profit growth slow meaningfully next year. Before Monday, shares were up more than 400% this year. And coming up, tech stocks tumble with the Nasdaq falling the most in nearly 8 weeks. We'll look if it was just fault of trade tensions or something bigger. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. U.S. stocks in the red on Monday, with tech leading the losses. That tech-heavy Nasdaq closing down more than 1%, but the tech sector remains the star performer in 2019, returning more than 40% relative to the S&P's 25% gain this year. Joining me from New York to discuss if there's a FANG overhang or if there is further room to run, it is Piper Jaffray's Chief Market Technician, Craig Johnson. Craig, thank you for joining me. Talk to me just for a moment here about today's price action. Something bigger that's happening that's creating the tech sell-off, or just a momentary pause?
I think this is more or less, Taylor, just a momentary pause. From our perspective, the market's had a very sharp advance, over 25%, coming off the lows we had seen in December. Stocks have gotten a little bit ahead of themselves, but from a technical perspective, we've seen 70+% of stocks above their RSI. We've seen an expansion in overall market breadth. We've seen tech leading this push higher. Wouldn't be surprised to see a little bit of profit taking in here. And Taylor, might I just add that this is a market that's really been pushed higher by the fact that really on the FOMO trade, fear of missing out. We're going to get some sort of trade deal done in Washington, and that equity markets are going to continue to push ahead. And perhaps the market just got a little ahead of itself, a little frothy, and today's kind of price action with the sell-off was a reaction to the commentary coming out of the White House today. I don't think it changes any of the longer-term trends of the market.
You have a chart in your 99-page report called the FANG overhang. Do you need FANG to go higher in order for everyone else to go higher, or could we go higher without the FANGs?
I think you're going to see, let me answer that question this way. I think you're going to see the FANG stocks participate. I'm not sure they're going to lead, but the chart that I had included in that particular marketing deck here for the East Coast marketing this week was really just to make the point that when you look at FANG AA, this is a index, an equally weighted index we created on the terminal that is not broken out to all-time new highs. So despite the market having made multiple new highs this year, a lot of these stocks have, this index index itself had not participated. Amazon has not been doing quite as well. You've certainly been seeing weakness in Netflix at this point in time. And let me just add that even if we don't see this FANG equally weighted index break out to new highs, I do think we're going to see the expansion in the overall breadth of the market in that case, because a lot of money gets tied up in those FANG stocks that can now come down cap into mid-small cap names. And I think that could actually be a very healthy broadening of the market. And I think right now, at this point in time, you're starting to see that happen.
Well, Craig, one of the stocks in your bullish thesis is Apple. If you come and take a look at a chart that I'm showing here in my terminal, Apple's market cap is worth more than the entire S&P 500 energy sector combined. Walk me through why Apple is not overvalued at these levels.
So when I look at the chart of Apple, first and foremost, let's start with the chart and then I'll walk back into the valuation side of this. And certainly Mike Olson does a great job from a fundamental perspective following that for Piper Jaffray. But just looking at this chart in here, you can see that you're still making a nice series of higher highs and higher lows. You can see that this stock had broken out of a nice consolidation range over the last 6 or 7 months or so. From my perspective, this looks like a stock that had kind of taken a time consolidation and is now starting to work its way higher. And when you look at the overall Apple products, its leadership, it's not a stock that to us looks like it's tremendously expensive at this point in time. I still think there's more room to go. And if I could just kind of add my kind of Peter Lynch kind of perspective, my wife and I had an opportunity to go to the Mall of America on Black Friday. And let me tell you, the Apple Store, I'm not sure you could have gotten more people into that Apple Store. There's a lot of demand for those products.
So you aren't factoring in regulatory and antitrust overhang into any of these big tech stocks as we head into 2020?
You know, at this point in time, I spend time thinking about price, trend, and what I'm seeing in these stocks. And right now, I don't have trend breaks on a lot of these big large cap names. So from my perspective, yeah, some of these overhangs might be there, but I think that's adding to the fuel of the wall of worry. And you continue to see stocks and tech stocks and Apple and some of these other names and these large cap tech names continuing to climb that proverbial wall of worry. And right now, until I get a trend change, we need to play these stocks to the long side.
I would note that no tech stocks were on your bear thesis. Is that a fundamental or a technical issue?
I don't know if it was either. When I was going through looking for names to include into this marketing deck, I was viewing this market from a more positive perspective, and so I was pointing out stocks that were more constructive looking. I did have ANET, which is a smaller mid-cap name that does look weak and rolling over, but overall, some of these big stocks and some of these tech names still look good. I mean, NVIDIA looks good, Skyworks looks constructive. There's a lot of names in the semiconductor space that to me look like names that still have room to run and still have room to work.
Well, Craig, we'd love to have you back and be able to expand more on that bull thesis. That was Craig Johnson of Piper Jaffray. Thank you for joining us. And coming up, the French president once had a tech-friendly credential, and now he's calling for greater control over big tech. That is next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. T-Mobile has jumped to an early lead in the race to offer 5G service across the U.S. The carrier's first 2 5G phones will hit stores this week. But the service that's being offered now, it won't be the hyped 5G experience that wireless services have been boasting about. It will offer broad coverage, but not blazing speeds. T-Mobile says it will offer a much better 5G network if its takeover of Sprint is approved. Now, French President Emmanuel Macron has toughened his stance on big tech. He has imposed a new tax on global tech companies that collect 25 million euros in digital sales in France. The tariff, which will be retroactively applied from the beginning of the year, is aimed at making those companies contribute to state coffers like their brick and mortar peers. The move follows a raft of fines led by the European Union against companies like Facebook and Google. For more, I want to bring in Bloomberg's Laura Davidson in Washington, D.C. Laura, as we've been mentioning, France has been much more tough when it comes to big tech than the U.S. What are the new laws and the new conversations that France is now having taking on big tech?
So basically, they're looking at a tax saying, look, you know, the consumers that are in France, they're not necessarily paying for the service. There's no tax revenues, but the consumers are there, and that France should essentially get a piece of that pie. So France was the first one to take that step, and you're seeing a lot of other countries, the UK, New Zealand, look at either passing those laws, or in some cases we've seen more and more of these get on the books. And this is really concerning the U.S., particularly because they see that as their tax revenue. These are American-based companies, and they said, look, if anyone gets to tax Facebook, Google, Amazon, that's us.
Laura, it's interesting how the conversation started about trying to level the playing field between traditional brick and mortar. Has the conversation shifted now to an antitrust or a data privacy concern?
That's part of the concern, but really the big tension point here is you have the U.S. saying, look, you guys don't get this money, and all the other countries are saying, look, but you guys are operating here, you have employees here, our citizens, our residents are using this service. So what we've seen is we've kind of at the large multilateral level, you have 133 countries sitting down trying to see if they can come up with some system to figure out basically which country gets to tax which company's portion of their revenue, which is in a massively complicated thing to do. And you really have kind of on one side or the other, you have the U.S. and you have France. And France is saying, look, we'll abandon our digital tax, but that's if you can get 132 people to agree to something.
So, Laura, how does the U.S. respond to protect our entrepreneurial spirit within the tech sector?
So that's something we're waiting to hear about actually today. The United States Trade Representative has been looking at this about several months ago. They opened up this investigation basically to see if there should be some sort of trade reaction. So they're looking at tariffs. They're looking at some way to sort of punish France and say, look, if you're going to do this to our signature tech companies, we're going to do something to some of your products. So President Trump in the past has talked about tariffs on French wine, for example. We don't know yet exactly what will be in this report. Nothing will be immediate. It'll be a 90-day waiting period with comments and some back and forth before anything that would be recommended would go into effect. But the U.S. is seriously looking at, kind of starting a little tit-for-tat battle here.
And it's also notable that they're not ruling out breaking up big tech. How would you do that in the EU, given they are American companies?
Yeah, so this is really difficult too, because they're trying to figure out, okay, if we're going to tax Google and Facebook, how do you draw a line of sort of what is big tech and what is some smaller startup that may be reaching that threshold. Also, this tax would also affect across the board. You're looking at pharma, you're looking at manufacturing. It's a really big 800-pound gorilla, which makes it really hard to get every side to agree to this tax. And at the end of the day, this means that some countries like the U.S. could end up losing out on tax revenue, where other countries, India and China, could end up winning.
Bloomberg's Laura Davison, thank you for joining us. And coming up, China is cracking down on cryptocurrencies, but miners are still churning out tokens. We'll take a look at the global effects next. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry Ann in New York and Heidi Stroud-Watts in Sydney. Let's take a look at those top global tech stories of the day. Sherry?
Taylor, Goldman Sachs made its third and biggest Latin American fintech bet yet. The bank is lending $125 million to Mercado Crédito in Mexico. The borrower, a unit of Mercado Libre, plans to use the funds to triple its $100 million working capital portfolio. Goldman's previous two loans were to Mexico's Confío and Credit Justo. Another blow to the co-working market space. WeWork competitor RocketSpace is pulling out of London. The company's UK employees were told last month that they'd be out of work by December 20th. Bloomberg has learned that San Francisco-based RocketSpace will instead refocus on funding services for startups. India's shopkeepers are uniting to take on the likes of Amazon and Flipkart. Merchants staged around 700 sit-ins at bazaars across the country over the past week, complaining that global e-commerce giants are engaging in predatory pricing. In October, India's government announced an investigation into the accusations. Amazon and Walmart, which owns Flipkart, told Bloomberg that their operations comply with local laws to operate as third-party marketplaces. Those are the top global tech stories we're watching. Taylor.
Well, the end of the year is not being particularly kind to Bitcoin and other cryptocurrencies. The world's most famous crypto losing gaining here at least today, 0.8%. It's now, though, at a nearly 20% decline over the last month. And it's not just Bitcoin. Other cryptocurrencies have also sold off after Chinese authorities took fresh steps to crack down on the trading assets of digital assets. Joining us to discuss it is Spencer Bogart, general partner at Blockchain Capital. Spencer, come and take a look at a chart here that I'm showing inside my terminal, all about the fundamentals, trying to hold in support at the 200-day moving average, but the RSI doesn't look oversold just yet, as you can see on the screen. Your thoughts?
Yeah, I mean, look, overall, I think China has definitely been driving some of the price action over the past couple months. But, I think it's challenging to read between the lines on what China's doing. I mean, we've seen some favorable moves in terms of Xi Jinping's move to blockchain the whole country and put it as a strategic priority. And then we've also seen some moves like Bitcoin miners were once put on a list of industries to be eliminated from the country. It's been removed from that list, so a slightly friendlier stance in that respect. And so while we've seen some crackdown on some of these smaller and shadier crypto exchanges, some of the larger ones seem to be getting a little bit more credibility within the country.
Spencer, how much does the fate of blockchain, of Bitcoin, of these digital assets really depend on a clear trajectory from China? Because as we know, with a lot of their policies, not just digital asset related, it can be, one step forwards, a couple of steps back, sideways. Maybe there's not necessarily a great deal of consistency. How hard is that for people that are betting on the future of digital assets?
Yeah, absolutely. I mean, look, I don't think that Bitcoin's future is in any way dependent on what China does. So I think it's helpful to kind of zoom out, get away from some of the near-term headlines, because I think in general, any kind of short-term trading strategy around Bitcoin is the wrong one. I think the question that people need to be asking is Bitcoin going to be more successful over the next 5 years than it is today? And I think if we look at all of the underlying trends here, they're all very constructive. I mean, Bitcoin's gone from being a joke just a few years ago to processing $1 to $3 billion worth of transactions daily. I mean, if we look back over the past 2 years, Bitcoin has processed more than $1.6 trillion of transactions. So whether it's that or some of the startups that we're seeing that are growing at incredible clips, particularly a lot of the on-ramps, so companies like Coinbase and Kraken, we're seeing a lot of positive growth across the industry as a whole.
But what about some of the regulatory overhang and the struggles that Facebook's Libra has had to face? Does that help or hurt?
Sure. So, I mean, look, the regulatory overhang is certainly real. There's always concerns that our regulators going to make it more difficult to acquire Bitcoin. But overall, Bitcoin doesn't need necessarily regulatory approval the same way a Libra does. The whole point is that it was launched in this nondescript kind of way and is now spread around the world, and there's 40,000 nodes around the world supporting Bitcoin. So its success doesn't really hinge on any kind of regulatory clarity, but certainly as that overhang kind of clears, it's definitely constructive for Bitcoin.
If you say that trading isn't the way to view or to play Bitcoin, and that you obviously need to take a longer term, step back to look at the possibilities that are held within the technology, how do you actually, I guess, capitalize on that opportunity if you're not trading it day to day?
Yeah, absolutely. I think one thing is position sizing. So, to take a step back here, I think it's a bolder bet or a riskier bet to say that Bitcoin will be less successful over the next 5 years than the past 5 years. I mean, all the trends suggest otherwise, whether it's that the value of transactions processed that I just discussed, or whether it's actually looking at what do people think of Bitcoin. So, we run a survey. We ran one in fall 2017 in the middle of a raging bull market. We ran another one in spring 2019. So this is actually done by Harris Poll. It surveys more than 2,000 American adults, and we use it to gauge the general population's awareness perception, familiarity, conviction, and propensity to purchase. And what we saw is over that 18-month period from fall 2017 to spring 2019, despite a significant market decline, the metrics were up across the board. So people are learning more about Bitcoin, they have more conviction in its future, and I would guess that there are going to be more purchasers going forward.
Right, so more people are learning about it. The retail audience is more engaged, they're understanding more. Can you assume, although I know we hate to use that word, that Bitcoin continues to move higher from here?
I certainly think so over any reasonable time horizon. So we don't make any kind of investments or bets on a weekly or a monthly basis, but certainly over the next 3 years, we're very constructive on the price of Bitcoin. You know, one thing that's coming up in a few months is the halving, so to speak. So this is Bitcoin's third halving. This is the rate of new issuance when it falls in half every 4 years. And so in May 2020 of next year, we have the next halving. So the rate of new issuance falls, it's a little bit less selling pressure, and I think that's overall constructive on price.
Well, then we'll have to have you back then to discuss. Thank you. It was to Blockchain Capital's Spencer Bogart. And plenty more global stories ahead. This is Bloomberg. The e-commerce, cloud, advertising, and markets that Amazon targets should grow by double digits to $2.9 trillion between 2019 and 2025. This is all according to Bloomberg Intelligence. Now, e-commerce could expand at about a 10% compound annual rate. Now, Pivotal research analyst Michael Levine says that Amazon estimates remain, quote, stubbornly too high, and the street should, quote, sharpen its pencils going into 2020 around several parts of the business. Michael joins us now. Michael, let me just talk, given that it's Cyber Monday, any thoughts on how Amazon could be poised to benefit from a big day like today?
I think that they're very well positioned. I mean, that you didn't really have the value prop of one-day shipping last year. I mean, I've seen them pretty aggressively out from an advertising perspective, so would think that they're definitely gaining share.
You know, Michael, I want to talk, though, if you come and take a look at a chart here that I'm showing in my terminal, it is frankly that Amazon, though, has been underperforming the rest of the retail audience. You mentioned the one-day shipping. Is that investment, is that cost paying off yet?
I think it's too early to say, but when I look at the quality of the management team, their track record of execution, I think they're making the right bets. The one thing I would frame that's worth noting is they rolled this out in the June timeframe, and something that I found striking was how quickly Walmart went ahead and responded. So my thinking is that probably you were seeing some plans in the wings by the likes of Walmart that may have pushed Amazon over the brink. So I think that they're making the right investment decisions. I think it increases the value proposition of Prime. You know, but look, it's not going to be cheap. And you know, to your point, when you're framing the relative performance of the stock, I mean, I was just looking this morning, and you see how much estimates have come down for 2020 in terms of EBIT since the beginning of the year, and it's been pretty profound.
So, Michael, the first line in your note here is Amazon estimates remain stubbornly too high in our view. What segments within Amazon appear the most overvalued to you?
You know, I don't know if I would call it overvalued, but it's like if I think through the three major segments of the business, if I think through retail, which obviously has been getting mostly impacted by the one-day shipping costs, AWS and advertising, I think that people's estimates for AWS, and we were pretty alone out there in terms of talking ahead of this quarter, saying that you weren't going to see a sharp rebound in terms of margins. You know, we still stick in that camp. I think we were a little bit more hopeful a few months ago that you would get to 2Q of 2020, you'd start to see a rebound, as this is when the step up happened, both in terms of hiring aggressively as well as the one-day shipping. And we just think that those two headwinds are going to be a bit more persistent than the street's currently thinking. So a little bit in both.
Yeah, talk to me more about the margins within the AWS business. I've heard more and more recently that they're having to use some discounting to make sure that they're gaining market share relative to Microsoft's Azure cloud product, to stay ahead of Google's cloud product. Has that been factored into the analysis, sort of the discounting to gain market share within that cloud space?
You know, I don't think it's super aggressive in terms of discounting. My sense is you've basically gotten adoption along a couple main chunks of the business. I mean, so infrastructure, everybody understands it at this point. Database, I think they've been incredibly successful at. In terms of storage, incredibly successful at. But the workloads are just getting more complex. So trying to explain somebody the value of, okay, I can migrate away from Oracle, run database on AWS, like people get that. When you start to get into things like AI, machine learning, and the clients in a lot of cases just aren't really ready for it themselves either. So I think a lot of the lean in terms of hiring is this recognition of getting the next series of workloads to migrate over to public cloud is going to take a lot more hand-holding by way of comparison, which for what it's worth, if I look relative to Microsoft really does not have as strong a culture of account management. So I think Amazon's probably thinking they can actually use this to their advantage in terms of actually gaining share.
Michael, how much of the lowering of the estimates can be attributed to a regulatory overhang and antitrust, all of the headlines that come out of Washington?
I think it's probably a rounding error. I mean, it's flowing through G&A, but the lion's share of the estimates that in terms of where we revised, we actually had already cut our numbers pretty aggressively for AWS. We took down EBIT a little bit, but I think we came to this recognition that, yeah, you're going to lap one-day shipping basically stepping up, but what hasn't happened, and I don't think the street's appreciating, is a big fulfillment center build out, which will be, we'll look back in a couple years and we'll realize like, wow, they actually needed to do a lot to get to an efficient ecosystem of doing one-day shipping, but this really just started a couple months ago in the big picture.
Michael Levine of Pivotal Research, thank you for joining us. Now we have a few headlines that we want to bring you. The first is the U.S. is proposing about $2.4 billion on a tariff on French goods. This appears to be in retaliation over the digital tax that France has enacted. So again, proposing about $2.4 billion tariffs on French goods that is over that digital tax. Second headline that we are getting is that the U.S. is now considering probing a similar issue on both Turkey, Austria, and Italy over those digital taxes. We will bring you more as we get them. And still ahead, the YouTube CEO Susan Wojcicki has appeared on primetime TV in the U.S. to defend the role of the video sharing platform. We'll find out what she said next. This is Bloomberg. The CEO of YouTube says her company is making progress in curbing the spread of harmful clips. In a TV interview with CBS's 60 Minutes, Susan Wojcicki also defended YouTube's role as an open platform and pushed back on calls to revoke laws that shield the company from liability. The video sharing platform has been under pressure from advertisers and regulators over conspiratorial and extremist clips. Joining us to discuss it is Bloomberg's Mark Bergen. So Mark, sort of coming out and defending the video and the content on YouTube, what did we learn yesterday?
Yeah, so this was an overview of things that Susan and YouTube have been talking about for the past year or so, right? A lot of their messaging has been we're taking they call it the 4 R's of responsibility. This is for a lot of employees, they're kind of late to this, but they're certainly working on one thing is to recommend a lot of this content less. And so in January they introduced something called borderline content, and they gave 3 examples. One is if you're a YouTube video that has an outright lie about a medical cure or something that's false about, say, the Holocaust or 9/11. And so their plan was, rather than taking those videos down because they say they don't violate our terms of service, we're just going to recommend them less. And that's been their tactic. And last night at 60 Minutes, Susan shared some results. They said that 70%, Americans are seeing 70% less of that content since they put in that policy.
And continuing to say we do not want to be held liable for the content, because if so, we'll have to review it. And if we review it, it just means that you'll see less content. Yeah, she did a really good job of sort of arguing this something that YouTube has said publicly and certainly probably privately in DC. Here that they were talking about Section 230, which is that law in the, that with YouTube and Facebook that doesn't make them liable for the user-generated content. It was interesting that this was the first time I've heard discussion about the possibility. She was asked if should they be liable for the content they recommend to viewers, and Susan said if we had to do that, we'd have to spend a lot more time basically moderating and screening that, and then people on YouTube would
would have less of this massive corpus of data. And in a sense, YouTube wouldn't really be YouTube, is their argument, if we have to be responsible for the content.
Another thing that caught my eye has been the political ads. And we know that Google has fallen somewhere in between Facebook and Twitter. So continuing to run an ad from President Trump, which makes some misleading statements about Joe Biden because they say it doesn't violate our policies, but they'll take down other ads that are blatant lies. Can you walk me through those policies?
Yeah, Google and YouTube has been a pretty opaque in the process so far. They put out a statement a couple weeks ago saying they're changing their ads policies, and one thing they're going to change is they're looking at all ads that they say have misleading information, specifically about voter suppression or the election. And so it would be it's a political ad to say, like, I don't know, tell voters to vote on Wednesday rather than Tuesday. That would be one they would take down. But it seems as if something like the Biden ad from the Trump campaign, which was about a candidate, that doesn't qualify. And so in that sense, they're taking the same position that Facebook has held. The Trump campaign came out last week and said Google was involved in voter suppression with this election campaign. So they are sort of between a rock and a hard place, and they haven't. And this was a full-on policy they did across their advertising portfolio, not just for political ads, which seems pretty smart. But the repercussions of this are clearly going to continue throughout 2020.
All things Google and YouTube. That was Bloomberg's Mark Bergen. Thank you for joining us. Now, 5G is fundamental technology change that is going to affect the way people do business. And that's according to the Qualcomm CEO, Steve Mollenkopf. He sat down with Bloomberg's Caroline Hyde to discuss the importance of 5G and the role that Qualcomm plays in this technological transition. Take a listen.
Well, I see it very kind of in the same way that maybe like you should think of it like electricity or water or these fundamental technology changes that change kind of the way people do business, for example. That's really how people in the industry are thinking about 5G. Clearly, it's going to impact the cellular industry, and you'll see a lot of benefits to the consumer and to the operators, the whole ecosystem. But you're also going to see when you have the ability to connect everything in the world, it's going to change the way people do business. It's going to change the way factories are structured. It's going to change the way we deliver healthcare. It's going to change the way that we do logistics and plan things. And this whole digitization of sort of business and the infrastructure of the world will be very significant. And it's actually one of the reasons why you see so much international desire to be first in 5G. It's because everyone knows the fundamental technologies are so important to the rest of the economy. Make sure that you're not behind.
At the moment, what is the sort of economic impact, do you think? Do you have gauges of how this will be from a US perspective, from a global perspective?
Well, we commissioned a study that tried to look at what is the impact of 5G in goods and services out in 2035. And the number was $13.2 trillion. So just a tremendous amount of money, at the point of super big. By the way, if we did that same study, I think it was 3 or 4 years ago, and it was 12.3.
So it's already scaling.
It's already scaling. And what's happening is people are seeing that it's happening. The things that they thought were going to happen are happening. And so I think it's a very positive element. And I would tell you, when we look at the broad customer base or partner, a lot of people come and talk to us about, hey, I know I have to be doing something in 5G. Help us figure out what that is. The number of people and the breadth of companies that come talk to us has actually increased, consistent with that, sort of proxy value that I just gave.
So what are some of the more interesting or surprising industries that have walked in your door wanting help?
What's really two of them, I think. One is, I would say, industrial, people's factories. What you want to see in factories is I want to be able to reconfigure it very, very quickly. And the data that comes off my machines, like a robot that's making a car, for example, tremendous amount of data comes off there. It is the actual fundamental IP of the car company, is how do I make the car, and then how can I reconfigure the factory? And what that means is they can now change how quickly they can react to the market in terms of having different model year reconfigured very quickly. Tremendous desire to do that. The other one is logistics. So if you think about, for example, a city like New York, moving things around, we really haven't done dramatic changes in the technology to move things around other than to just create more streets. But when you can connect everything and you can figure out how to optimize that, and you can do all the AI and you can do all the big data on moving goods and services people and things around a city, and as cities grow larger, it's tremendous advantage to those cities to figure out how to do that. There's a lot of desire for people to get things connected so they can start that problem, in a big way.
So do you feel this sense of responsibility that you're a driving force behind this technology, that you're in the race to win it for the US to a certain extent?
Yeah, I mean, probably broader than the US, actually. I mean, if you think about it, so our business model really, if you go way back, sort of the highest level of abstraction, is about it's about really creating a bigger pie. So you're trying to make the market grow, and then particularly in areas where a market is developing that didn't develop before, we do very well in terms of creating value for our shareholders. And so what we think about is, how do I create an industry that doesn't exist? What are the fundamental technologies we need to create? How do we get them into the standards bodies, and then how do we scale them, meaning share them with everyone? What we don't do, because we're not good at doing this, is figure out what is the end product. What we try to figure out is, what is the hardest technology and what can we deliver the biggest piece so that people can innovate on top of it. And so from that perspective, you look and say, wow, okay, logistics is going to be big, digital healthcare is going to be big. What do we need to do so that 10 years from now, some company will be, that everyone will know, will develop and use these technologies? If we can do that, we'll be able to deliver for our shareholders and really deliver for this goal to grow the pie, I guess.
That was Qualcomm CEO Steve Mollenkopf. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok, on Twitter. This is Bloomberg.